Good afternoon, ladies and gentlemen. Happy Friday, October 5th, 2018 to you all. Welcome, of course, to our presentation, the regularly scheduled Friday 4:30 p.m. Options Open Forum Q&A session. So an interesting day today. A lot of things seem to recover a little bit and move back up towards the end of the day, but there's some perilous moments there during the trading day as well, which benefited, I'm sure, some of us and didn't benefit other positions in our portfolio as well. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Now, I always want to begin each presentation with just a review of what is Power Options at PowerOpt.com. Well, it's a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance. We support over 23 of the most commonly used option strategies. You can search for positions in a given strategy based on your criteria, further research and analyze the stock or the option. We also offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions as well. Of course, we do offer countless help videos, blog articles, white papers, and archived webinars to help you get more familiar with the tools on the site, but more importantly, the various option strategies and management techniques as well. Ernie Zarina created Power Options back in 1997. But everyone here on staff uses these tools to trade their personal accounts. In fact, I don't even log on to my broker, I log on to my broker just to place a trade. By the time I log on to my broker, I've already made all the decisions of what I'm going to do using the different tools on Power Options. Now, our process and procedure for these Friday afternoon presentations, when you logged on to the webinar, GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. Just use that pod to send us a question at any time during the presentation. Please feel free to ask as many questions as you want. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. But if we have a high volume of questions, we'll be more than happy to stay online a little bit longer to make sure all questions are handled. Your questions can really be about anything related to options or options investing. If you have questions about a general option strategy, what's the structure I should use for a covered call, or how should I build a bull put credit spread or an iron condor, for example? You may, of course, have questions about trade management. How could I adjust this position? This stock moved against me. What could I have done in this spread or in this position? What are some of the management techniques of a bear call credit spread, for example? That's all fair game. You may have questions about basic option specifics. Just what is in the money, what is out of the money, what is gamma, what is delta, what is theta, or even, of course, the options basics as well. That's all fair game. Many of you may have questions about the tools on Power Options, setting up a search in a given strategy, how can you use a certain filter, how to adjust positions in the portfolio, and of course, we'll probably have a few questions about the concepts of the limited risk radioactive trading techniques, as well as other strategies, I'm sure. And that's all fair game. Our basic ground rules: don't be shy. Please feel free to ask any questions you have at any time during the presentation. Now be patient. There might be one or two questions ahead of yours, and we are going to cover two questions that came in via email, really one question that came in via an email, and then some general thoughts that came in as well before we get into the live questions. We always encourage you to feel free to help us help others. If a question comes in, and I give a response based on my market experience, what I've done in my personal account, or conversations I've had with other customers, but you have a different way of managing a position or evaluating a trade, well, I encourage you to send that to us in the question pod, and we'll share it with the rest of the audience as well. Of course, I may ask you for clarification on your position, or your question, I should say. There's a lot of names out there, a lot of different structures, a lot of different common strategies, quote unquote, with a twist. So I want to make sure that I've got the information correctly before I start discussing or looking at the position or the profit and loss chart you're asking about to make sure we're on the same page. Of course, most important, let's have fun. We're going to cover about 10 or 15 slides, I believe, and a question from Marc K. Then we're going to take your live questions, but let's have some fun, get into October, and further into October, the weekend. Get ready for a nice, relaxing weekend, but get some good education under our belt as well. All right, so via email, Mark sent me a question Tuesday or Wednesday, and I replied to him via email, and he sent the question again today. So Mark, I see you're online. I don't know if you're getting my responses, but I did reply to both of your emails, and I was planning on addressing your questions today as well. Okay, so Mark's question, Mark's view is that, starts the question, so does it make sense if someone is looking just to get interest income from a stock, let's say 5% over the period of a year or an extended period dividend-wise, to enter into a long-term collar trade? Well, the question is, the answer basically is yes, but he goes on to describe this different form of collar structure he's looking at. So Mark says stock trading at 50 with a 52-week low of 40. Buy the stock at $50 per share. Buy a leap vertical put spread, let's say a 1 year out 50-40 for $6. So what does this mean? We are going to buy the 50 strike put 1 year out sort of as protection for the stock, and we're going to sell the 40 strike further out of the money, below the current stock price at 50, and it's going to cost a debit of $6. Okay, so it's a bear put debit spread with a cost of $6. Then on top of the stock and the bear put debit, sell a 52 strike call 1 year out in time, same expiration as the put spread, for $6.25. Okay, now, before I jump into that, how I put this together, there is a specific selection I found, but of all the stocks I found in the $50 range on Power Options, going out to a leap, which really forced it to go sort of to January 2019 or January 2020, I took January 2020 as an example. None of the stocks that were in the $49.20 to $50.85 range offered a current spread where you could get a credit for this transaction, where I could do a 50-40 bear put debit and sell the 50 call for 10, 15, 25 cents higher. They were all at a debit. Most of the 52 calls were only around 5.20, 5.30, and the bull put spreads were around $7. So that's one thing. But in theory, if you had found this stock, if you could get it for a credit, that's what we're looking at. 22 stocks, I believe, when I ran the search at 11 a.m. this morning, none of them, 20, 18 or 20, offered this structure with a net credit. It was all done at a debit of $1 or $2 in some cases, which isn't too bad. But let's break down this collar that we're looking at. Let's break it down into two distinct components. First off, it's simple. It's a 1 year covered call. I chose EWW for an example. We could buy the stock at 50, and we could sell the 52 call for around $6.25. All right, so we get some appreciation, be around an 18.9% 1 year return if assigned, not including the 5% coming in for dividends if you weren't assigned early, which may or may not happen depending on the situation. It does offer a 12.5% downside protection. What does that mean? It means the stock can fall 12.5% or down to $43.75 just with the covered call structure, because we took in $6.25, right, before you start losing money on this part of the position. Okay, so I did use the January 2020 in this case, which is 470 days at a time. So this is one of the two components of this collar that Mark had mentioned. Okay. All right, and Sam, I'm going to get to that. I know you're going to have a comment on this, so I'm going to get to that, but I'm going to walk through this for Mark, and then we're going to ask a few questions, okay? All right, so the second component is the bear put debit spread. We're going to buy to open the higher strike 50 put. Now, this also kind of acts as protection for the stock, but in just this bear put debit structure, I'm buying the 50, selling the 40. Okay, so I might be obligated to buy shares of stock at 40, but I have the right to sell them at 50. We put in a debit at 6. Okay, I just put in some fake numbers. So selling the call for $6.25, buying the put for put spread for $6. We still have a 25-cent net credit. Now, if the stock does fall below 40, we get $4 back, right? My broker would essentially buy shares of stock for me at 40, exercise the 50 to close that position, and we'd get $4 back. But this one put can only cover one of two things. It can only cover the stock or the short put. If it does fall below 40, it can't cover both. We'll get to that in a moment. Combining the two together, what do we get? Well, we get sort of a plateau hockey stick graph if you're trying to draw a plateau in Geology 101 or a step formation, I guess you'd say, in Geology 101. You kind of get this structure. We have a maximum return if assigned 470 days away of 4.5%. If we get assigned at 52, we make $2 above the stock price, keep the 25-cent net credit, and if you've got another, well, in this case, it'd probably be maybe 6.5 to 7.5 dividend over 470 days, this would go up to about 11, 12% return if you include the dividend if you're in it for the entire time. The worst case scenarios, you begin to lose if it's below 40.70 or 39.75. That's your lower break even. Why? Well, again, we'd get taken out of the bear put debit spread at expiration, get the 10 points back, but we've lost $10.25 on the stock. So it's still starting to decline, and we keep the $2 premium or $6 premium essentially we got for selling the call. Okay, so that's where we start to lose money, is right after that 25-cent net credit below that lower put strike price. Okay, and then what you're seeing here, this curved red line is at the halfway point. This is the profit and loss chart we're looking at. Now, Sam, to your question, 3 slides later I'm going to get to your comment, Sam, regarding this. The follow-up, Marc says there's no cost for the protective put spread. Okay, you sold a call at 6.25, you got this at 6. The 18 or 19 trades in that $50 range that I pulled up today going out to January 2020, this combination could not be done at a credit. All the 52 and 50 to 40 bear put combinations with a short call were all done at a debit. Okay, so the thought is the protection is more about the 52-week low. It's not likely to go back to that strike, to the $40 level. I have 3 stocks right now that are hitting new 52-week lows, even in this, well, 2 actually. 2 that are hitting new 52-week lows in this market condition. So I'm going to say anything's possible. Okay, but you are collecting a dividend along the way. Now, the example I showed you, 470 days out, max return, not assuming adjustments, and I'll get to that in a minute, is 4.5% if it does what you want, moves above 52. And let's say you get a 5% dividend per year, or 7.5 roughly for 470 days. So that would put you at a 12% return, 6% almost per year. First question, does even the dividend increase meet your goals for a 470-day trade? Okay, that's a question you have to ask for yourself. Now, a possibility of loss if the stock goes lower than 40. That's right. Suggestions on how to manage it are appreciated. Okay, I'll talk about that in a moment. And then he also mentions the possibility of stock getting called away, but this should realize a gain in addition to interest collected. Again, is it enough? You showed me an example at a credit, Marc, and I put that in, and then including the dividend, we're talking about a 12% return. All of the ones I saw were at a debit. So instead of a credit of 20 cents, I'd be paying a debit of, mentioned some of them were $1, some of them were $2. Well, that would be $100 or $200 less profit to the upside because that structure was done at a debit. So now you're only looking at maybe 10% return over 470 days on the debit between the call and the bear put spread. I don't know if that's going to cut it, okay? But is it enough? That's a question you have to ask for yourself in this structure. Graph it and see if it works. But let's move on. First, a review. This is to Sam's. Sam made 2 comments while I was discussing this. He says, I feel when you sell a call or puts, it is better if it's short-term than leaps. I agree. And what if he does a calendar, the buy the long and sell the monthly short? Again, options give us options. He's looking for a single-digit risk without getting into leverage, I think, of spread positions, trying to protect the stock and collect the dividend. Now, Sam, you're right. A long-term leap with a short-term calendar, percentage-wise, is going to look higher because it's leveraged. But what is an interesting thing about that graph at expiration? Let's go back one. this nice spot between 40 and 50, I got to get the green pen, and never defaults to the green pen on this, but this point here at expiration is a profit. Well, it's only 25 cents of profit, but anywhere between $40 and up is a profit. 25 cents or $25 here, increased profit here, max return of $225, sans the management. So it's a long range of profitability. It doesn't start to lose until it goes below $39.75. That is a very good component of this structure. But again, we're talking about the rest of it. And this goes to your point, Sam. This is what we have to review. Whenever you're selling, you want to be selling 14, 20, 30 days out in time because you want the rapid time decay of the premium in your favor. When I'm buying for protection or for a leap, as Sam mentioned, I want to be out in this time frame. 160 days, 180 days, 200 days, 6 months or more, perhaps, depending on my outlook for the stock and how I want to stand. If I'm buying a married put, if I'm doing a calendar spread, I'm usually at least 5 months, 4 months out in time, 120 days or more. We're at 470. We're over here on my other screen, okay? So we're going to have a very, very short time decay. That actually hurts all three options in this structure. Why? As your 50 put and the 40 put retain most of their time premium, even if the stock's staying right at 50, well, this isn't losing too much. Remember, you bought the 50 put. That's not losing too much, but you're not gaining on the premium that you sold into the 40. You're really not going to see a lot of time decay until you start getting into maybe 6 months, and then it's going to increase. But then 90 days to that, 90 to 100 days to that expiration is going to start to slope off. In the last 30 days, it's going to go to zero. If it's below 40, something drastic happens, and I know this is an extreme, it's not likely, Mark, but if something drastic happens and that stock drops to 40 in the next month, or that ETF drops to 40 within the next month, there's still so much time value left on this, you're not going to get $10 back. You're not going to be at that intrinsic value you're looking for. You might only get $5 or $6, hopefully at least $7, because you still have 400 days of time premium. At the same time, even though the stock's falling, you're going to lose some value on that 52 call. But it's still, even if the stock's at 45, it's going to retain $4 or $5 maybe, maybe $3.50 to $4.50, maybe $5 of time premium. You're not going to be able to buy it back for 10 cents, 15 cents until you get into this time frame, or unless the stock's trading at $13, $15, maybe $20 per share. Okay, and that's what Sam is alluding to, but that's the basic component of any options trade, is you want to maximize your annualized return by selling near term and lower your annualized cost by buying far term. Okay, that's just the basics of selling and buying options. Okay, but let's go back. Major problem here, in my opinion, first glance, time decay is not on your side on the short call and on the spread. Okay, you can see that by the curved profit and loss chart. This is the halfway point based on the Black-Scholes pricing models for what would be remaining value on the call and the bear put spread. Notice even here at 50, you're at a small loss of probably 25. Here we're about 75 at about $47, $48. At $46, you're at a $125 loss at the halfway point. No, I'm sorry, yeah, at $42, you're at $248. Okay, it's not that bad. But the halfway point is May 9th, 2019. Okay, so 6 months away from now. Oh, it's not. It's more. I'm sorry. It's more than that. It's May of. I think it was May of 2019. That's the halfway point when looking at this structure. Okay, so even if the stocks start to fall, your time decay is not putting you in this positive that you thought, halfway into the trade. Okay, so that's what we have to look at here in these situations. Did I have another comment here? Let me just check this real quick. Sorry. Okay, yeah, Sam was just commenting that sometimes when stock's at a 52-week low, if the fundamentals are no good, it can go down to 20 and 10 and 5. You've seen stocks in a long-term bearish mode never recover from like a few years. TNDM was one, and so forth. So Sam's just commenting is that, you know, your stock might be at 50 and the 52-week low is 40, but if this has been in a downtrend, it might continue down to that level again. He's just mentioning a concern about hoping that it's not there. Okay, but let's talk about your management, Mark, in this question. What would I do here if the stock falls? Okay, what's happening to this position? My stock that has a delta of 1 is losing the most money at this point. And you can say, oh, well, the put's hedging it. Well, kind of. It's hedging it into here, but remember, this put is also increasing as well, and to close it, you have to buy it back. This, as the stock falls, is increasing more than this put, but this is a negative to you. This is a positive as it falls. This is a negative on the stock, and the call is the positive. But remember, you're not seeing, these are both increasing, the 40 and the 50, but your call is not decreasing that rapidly. It's still retaining a ton of time value. Now, if this happens, you stay in this all the way, and then 2 months to expiration, it starts to fall short. Okay, then you'll start to see more decay in that call. But if the stock starts to fall, what would you consider doing? Well, the bear put portion is doing exactly what you want it to, but you're losing on the stock. So how are you going to hedge the stock now? Well, you could either buy another put. I'm not saying that far out in time, but you could buy another put as the stock's falling. You could roll down the call. But what happens whenever you roll down a call? You're in a covered call position, you roll down a call. You might be able to roll for a credit farther out, but if you roll down in the strike, because the stock's at 45, you got to roll down to 50. Remember, this positive return is always going to lower. You're going to be lowering your expectations by moving down, even though you're collecting a premium. Yeah, and just like you can see here with this, is Sam mentions that was it Sam that mentioned that? Oh, no, it's Rajiv. This is one of the problems with this type of structure, Mark, is that day to day it will show a negative return until 90% of the entire time frame. That's pretty close. I mean, even if it moves up, you're still going to be showing negative in the near months. It's going to be hard to gauge a management technique on this because it's always going to seem like you're losing until you actually start to get a reasonable amount of time decay. Okay, well, if the stock rises, what could we consider doing? Well, we'd probably have to move up the short call. Let's say it goes up to 55, 56, or 57. But now you're going to pay a high debit. You're going to have to maybe roll this out to the January series that you're in over here in order to get to that structure, right? You may have to go further out in time. Oh, I'm sorry, you're already at the 470. So if you go up, what happens? You're going to have to roll for a debit because this is the furthest out you can go, and that's going to lower the upside return as well. You could move the bear put spread up or just move the long up as the stock's rising. Okay, this will increase this. But again, it's not helping you because you're losing money on the long option, and then you're going to have to buy another one at a higher strike. You're going to be paying a debit to that, which is going to lower the upside return. Okay? Really, in your gauge, for over 470 days, even collecting the dividend, you're just going to want to be somewhere in here. You don't want the stock to move, let's say, more than below 45, more than maybe above 54 or 55, and you might not want to roll that call because you're not going to get much for it, okay? Yeah, and I think this particular one, this EWW, Sam, I was looking at, I think this does pay a dividend, and that is, it is an ETF, and it's an obscure ETF, but it's the one that was closest to $50 that offered a straightforward 52 strike and not a 52.5 all the way out to January 2020 expiration. But you're right, SPY could be an example, something along those lines, okay? And Rajiv brings up another point, Mark, that I was going to get to. Sam and Rajiv are getting on top of me here before I mention that. If your goal was to manage the position, or you're thinking about managing because you want to make more than this if it moves up, hopefully, or you want to try to protect this more, Rajiv brings up a comment I was going to get to in a moment is, well, why would you do this long-term trade anyway? If you're looking for management, maybe you should just be buying this far out in time, put as a structure, and then selling near term against it and rolling the call or making other adjustments as it goes forward. Okay? Is this safer than a married put, straightforward married put or collar at expiration? Is it safer during the time frame of the trade? Well, the answer honestly is no. If you ask for safety, is it safer than the married put at expiration? No, because this has an infinite loss technically to downside. It's not infinite. You get out of this spread here for the 10 points. Okay, that counters 10 of the points you lost on the stock minus the $2. It goes down to 0. Well, you still lost about $3,800 for 100 shares. The Married Put is flat base, as is a standard collar. It can't go beyond that. Is it safer during the time of the trade? Well, not necessarily, because see here you still have a large loss. Now I know you're not expecting it to drop below 40. Let's say you put on this structure and didn't plan to manage it 2 years ago on GE. Where are you now? I know that's a crappy thing to do for an example, but that's what can happen. I rather would have been in a Married Put with a 2-year out leap on GE if I'd opened it 2 years ago as opposed to this structure. There are examples where that can happen. I'm not saying EWW is going to do that. I'm not saying a lot of stocks are going to do that, but you have to take that into consideration. Then you would have to consider managed. Of course, as it's falling, this put is gaining, but so is this one. You might be able to manipulate this put. You're not going to help the bear put debit spread, but remember, you're trying to hedge some of the stock, but the minute it goes below 40, one put can only cover this stock or that short put, not both. You're still losing big time on one of them. All right, so side by side, let's take a look at those two questions. Is it safer? Halfway point is 5/29/2019, so I was stumbling on that. All right, here again is your position. Here would be the same Married Put I would open using the 52 strike. I'd buy EWW at 50. I'd buy the 52, maybe the 54 strike for a little bit lower than, a little bit lower than a 7.8% risk. Okay, but over the time frame of the trade, if the stock drops to about 47, okay, at the halfway point, I'm about a $300 loss here on the Married Put, and at 47-ish, we're at about, a little bit less loss. Okay, so it's probably a little bit safer in that term, but I'm doing this as a bullish trade. If I enter the Married Put, of course, I'm neutral to bullish. Sam kind of hinted at this, and Rajiv mentioned it too. If this is a structure you want, you're sort of neutral as can be. You want it, again, to be just in this range of about 45 to here. Really, you want it just to be in this range, somewhere between 52 and 50 at best, and stay in that range. We're not really comparing apples to apples, because here I'm expecting maybe an 8, 10, 12% growth on the stock. If you expect that over the course of a year, this is the wrong trade. It's protected to a point, but it caps the gain at 4.5% for maybe a 12-month period. If I'm expecting a 10% gain, I'm doing something that leaves that open a little bit more. And as we've been talking about, I'm going to be making short-term adjustments, selling calls, doing the riskless spread trades nested in the Married Put position, or maneuvering the put, if I'm right, to lower this risk and cut it in half. It's harder to do with this one because you could roll this put up if the stock moved up, as I could, but now you're doing some weird things here with this portion of the spread. This will actually drop to a negative and then go back up here if you roll the put, because it's going to be done at a debit. So you'll no longer be positive here if you just roll up the put thinking you're going to get lower risk. You might increase the break even, but you're going to drop this positive flat line that you have at the 25-cent net credit into the loss range, and at the same time, you're going to be lowering that upside return. Meanwhile, if I do it, I still keep in limited upside, and I cut my risk in half. So there's balance there as that as well. Okay, all right, and let's see here. Okay, Sam, I'm going to get to your comments you're putting in on this discussion when I get to your emails. Okay, so why am I not a fan? Last time, why am I not a fan of this? You're tying up money for an extremely long time. The benefit of the time value decay that's needed to get the $10 even back on the bear put debit spread if you're wrong, or to be able to buy this back, roll it, or make adjustments if it starts to move up, you're not going to see until maybe 400, 420 days into the trade. It's going to be much harder to manage because time decay is not working in your favor. It's a 4.5% return. Let's say you're expecting a 5% annualized yield, so over maybe a year and a half, that's 7.5, so you're looking at a 12% return for 470 days. Possibly. Does that match your trading plan? Does that match your trading goals? It's not a bad return, 6%, a little bit maybe, we could call it 5.5% per year, or average, something like that. It's about a year and a half or so. Okay. So a year and a quarter, I'm sorry. It's about a year and a quarter. So that's what it's coming down to, is knowing what the structure is, knowing that it's not really protected. It's only protected to this 52-week low, but we've seen a lot of stocks go through that if they have bad fundamentals and bad technicals. Okay. Yes, it's got this middle point here that is profitable because of the bear put debit spread if it's trading between, but that's 470 days away. You'd be tying up, $5,000 for just 100 shares for 470 days, looking at a $25 profit. That's not worth it, but you didn't lose. I like that. Okay, you didn't lose. Got to admit that that's good. Okay, but it's kind of going against the idea of what you hear Rajiv saying and Sam saying, that if you want to be able to manage more easily, you want to be selling near term and be buying for a calendar spread or for a protective put position further out in time and selling near term. It's easier to adjust. It's easier to move. If you just want to fire and forget trade where you collect dividends and have a low risk, I might buy the stock at 50 and buy a 55 put that's 2 years out. It would probably be a 4% risk, worst case scenario, below 55. I get the dividend over 470 days. I'm positive. Bulletproof trade. This is not. Okay? This is a similar issue of discussion of collars I've had that have come up this week and have also come up in the past. There's a service out there that teaches, I don't know what I want to call this. I don't want to call it a reverse collar. That's kind of what I call it. I might call it an opposite collar. But going with the same construct, when I do a collar, a standard collar, I either want the expiration of the short call and the long put to be the same, or I want the short call that I'm selling to be shorter time frame, much like a diagonal spread that Sam mentioned. Okay? Now, what if we reverse it? What if we buy the stock at 50, sell the January 2020 55 call out of the money to give us some room for 258? These are the prices around 11 o'clock this morning. Buy a closer in 2019 March 45 put at 132. Okay, so you get this neat little check mark profit and loss chart. Max risk only occurs at 45 and it's up at 9.5%. Max return is showing up at around 11.4%, but up in this range, okay, and that's about accurate. And then even if it continues down in price, you're losing about $400 or so, which still comes down about 8%. It's higher than what I had on the Married Put to begin with in the next 6 to 8 months to 2019 March. Okay, this is the chart at 6 months. This is the chart at March, not all the way to January 2020. So what's going to happen? Everyone says, oh, well, there's ways to manage it. Okay, whoever is teaching this doesn't tell you the management. You've got to buy their product, so they show you how to manage this position if it goes up or if it goes down. Okay, well, the stock goes up. Let's say it goes up to 57 in the next 6 months. What didn't I get any benefit from? A heck of a lot of time decay from this call. It's still got a year plus to go. The time decay didn't work in my favor. You know what went to zero, though? This. Now I've got to stay in the position. I've got to decide, do I liquidate? And I didn't get a lot of time value decay, and my stock is up to 57, so I've got $7 worth of gain there. I lose the 132 on the put. Okay, so I liquidate it, but am I near 11.4? No. I'm probably near 225 and probably at 5% for 6 months. Does that match your trading goals? Next scenario, it's right up here around 53 or 54. Still haven't seen a lot of time decay in my 55 call. 45 put expires worthless. I still think there's bullish upside. I need to stay in it. What do I need to do? Buy another buy another put for $1.32. What does that do? Takes away the credit. It was only $1.26 to begin with. Now that's a negative credit. It's a debit. So this return drops. Max return best 400. This risk goes up. Now I'm at a 1-to-1 10% potential gain, 10% loss between 45 and 55 if I use those strikes, but let's just say it. And so what ends up happening? Well, I would have been better off doing something closer in time than waiting 470 days to potentially see a 9 or 8% profit above 55 or 10 or 11% loss below 45. They might have some other management they use for this and some rules and some guidelines that works for them. But this goes against the basic constructs of options. I don't want to be selling premium farther out than I'm buying for insurance. It's not really low risk. Okay, it's actually a higher risk than opening the married put to begin with in all scenarios, okay? And if you have to manage it by buying another put to stay in it longer to have the protection, you're going to cut the return and you're going to increase the maximum risk on the position. That's going the opposite direction of what you want to see. Okay? You want to be lowering the risk and increasing the return, not the other way around. Not a fan of this position, okay? But again, it's something that came up when you try to get with these ideas of selling longer term because you see a higher premium there as well. Now, you probably know what I'm going to say next. Well, is it a bad strategy? I'm not saying it's a bad strategy, Mark. I'm just commenting on the structure that you gave me. I told you the pros and the cons I see with it. I don't know if the return, even with the dividend, is enough to match your trading goals for that long-term trade. You may be in it for 400 days before you really get the return that you want by trying to liquidate or roll the call. Don't know if that's going to match your goals. This is a positive that anywhere between $40 and above, you're profitable on a stock trading at 50. That is pretty good. But again, it's only 25 cents. So if you did a trading plan of this with, let's say, 10 stocks, and 8 of those stocks over the next 12 months, we have sort of an up and down market, 8 of those 10 end here, one of them goes up for the full profit, and one of them takes a small loss, you're barely just going to be above break even. And remember, all 18 examples I looked at today on the stocks in this price range that offered January 2020 series, this was all done at a debit. So this range was all negative by about $1 or up to $2. And then it came up in the return and down here for the loss. This was based on your numbers, and that structure looks good if you can get those numbers. I didn't see those. So what is your poison? Something like this, which long-term caps the gains. This opposite collar, where you're selling far term and you may have to manage it again, which will, if you do have to add another put, is going to lower the return and increase the risk, or a straightforward put where anywhere down here is a loss, but short term we can manage it to cut this up and lower it effectively and still have infinite upside, or maybe even a capped gain like a diagonal calendar, but increasing it. Okay, you have to decide that. And there's not a ton of people with us today, of course. We don't have a lot in our audience, but let me just ask. Looking at those 3 graphs, Marc's covered bear put spread 4.5% max, not considering adjustment, which he'd be planning on doing, but I think we discussed how the most management of that would lower the return. Does have a limited loss structure, but it has the most potential for loss to the downside. The opposite collar, selling a 1-year out call and buying a 6-month in-time put. Doing a married put to begin with, which just has the infinite upside, longer term plan, and then you can sell calls or do other thing against it, and then not shown maybe a standard collar. Now I already know 2 of our audience is going to email in and say, or use the question pad and say, well, no, I wouldn't do either of those. And that would be Sam and Rajiv. Sam and Rajiv might start off in this situation, okay, and might start off with a longer term put 5 or 6 months out, but they're going to be doing a lot more near-term trading in between, okay. Sam does mention that long-term shorts does not work because you're giving up too much time for the stock. That's right. You're giving up too much time for the stock to go against you. You don't get that time decay until a good point later on, and that becomes a little bit difficult as well. And so it does move against you. Okay, so I'm sure some of you would say, well, I'm probably not going to do either one of these 3, and that's perfectly fine. I just wanted to know. But of those of you who voted, few of you voted, and all of you said the married put would be more of your preferred position here as opposed to Marc's covered bear put debit spread. And that's no insult, Marc. It's an interesting structure. And if you're just looking to collect the income with a low risk, that would work. Your structure would work, assuming that it doesn't move too much between 2, it doesn't go below 45 during the trade, really, or it doesn't really go above, let's say, 55 or 56. Because anything managed you do then, you're going to cap the gain in that point. You're going to lower the gain further in that point because you're going to be adjusting at a debit. And if it's below 45, it's still manageable, but you won't really get the time decay you want on that short call until you get closer to expiration. And I personally am not a fan of number 2 because I think it's deceiving. I think it's deceiving to say, oh, well, don't worry about the protection. You've got that 6 months out. If it doesn't work out as you expect, you can manage it later. Well, manage it later means if I've got to stay in it to manage it, I've got to buy another put. That's not going to increase my returns. That's going to increase my risk and lower my returns if I have to stay in it for another 6, 7 months to try to get that maximum profit, which has now been lowered. Okay. Different strokes for different folks. Options give us options. Pick your poison. Okay. Just looking at the structures, which one do you think works best for your plan and your trading goals going forward? It's hard to say. We don't know the future. Hindsight's always 20/20. All right. Okay, so let's real quick go review some of the things that Sam was talking about. Sam says he did a Nike straddle before earnings, paid in $5.30 for the calls and the puts. The stock moved only 2%. Yeah, that's some of the problems Ernie has with his earnings strangles as well, and straddles, I should say. But you didn't get what you wanted. It was at 81. You bought 2 calls. You got some return on the calls when it got up to 85. So it moved up to 85. You got some profit there, and then you bought the puts, and it pulled back down to 80. So you ended up making a profit on the position, but not because of earnings, but because of going forward. Then he shows an Apple call spread there, 232.5, 230. Puts at 162.5, 160. Both expired next week. Okay. So what he's just showing what he's doing now. Sam says he does straddles. He's saying he does straddles, and he does do straddles, but Sam is an active straddle trader, and you just saw that, which means he doesn't just buy the call and the put and leave it and hope for a movement. Okay, he's moving with the stock. He's watching it more constantly. So when it was bought the 81s, bought 80 calls extra or 81 calls extras, they started to move up after the stock was down below 80. Got some return there. It took profit on the calls when the stock was at 85, and then he bought puts. Okay, so he's moving in and out of calls and puts and holding calls and puts at the same time based on the movement of the position. He's not just putting on a straddle and hoping it's profitable based on the earnings. He's trying to manage them effectively to get to a profit. And he does say the money he invested in straddles this year is up 189%. Sam also occasionally sells calls in those straddle format or sells puts if he thinks that that's the direction to kind of lower the cost basis. So he's doing a straddle, but he's also managing and legging around the straddle, and he's also selling premium in and out. So it's not just your straight V-shaped straddle, buy call, buy put, hope there's an event, stock goes one direction or the other, and you make a profit. There's movement in between of selling, buying some more, hitting a peak, buying, and then taking profits in the other direction. Okay? So it's much more intense than just putting on a straddle and hoping that it's profitable. And he's very profitable. He says stocks are only up 30% in my account so far this year. He's trying to finish at 200. And I think what you were saying is that you had a total of 100 puts in 3 stocks and 3 ETFs. What would that be? 6 positions. So roughly, I'm sorry, 5. I'm sorry, five puts in each, I guess. FB, Apple, and Snap, and then SPY, IWM, and DIA. You're only holding 20 puts right now. So he's cashed out on the put side for most of the positions based on today's movement. Okay, so I just wanted to review that. That's not where we're stopping, of course. I just wanted to, that was the comment Sam was mentioning about his straddles. And I always just want to clear that up because sometimes when we talk about straddles during these webinars and we talk about the movements that Sam has had, some investors might get the impression that we're talking about just the straight fire and forget straddle, and that's not it. There's management involved, which is good. You know, I think Sam is doing, obviously, I can't fight with those numbers, but Sam's doing a good thing. But it's legging in and out. It's moving up and down, okay? All right, back to our, I'm going to do a quick thing. Back to our previous discussion. Sorry, folks. I apologize for this. I don't usually like to go out of order because Sam and Rajiv has some questions and Sam has made a couple of other comments. But I want to go back for a minute and talk about our 3 positions we were just looking at. The 2 collars, okay, you know, the opposite collar I just showed, my apologies, and versus the married put versus Marc's covered barefoot debit spread is what I'm calling it. Okay. Fernando asked another question. Let's stick with EWW. And this is a common question I've answered. There's multiple webinars on it on YouTube and in RadioActive Trading, of course, as well. I refer to it as the 3 core principles in trade comparisons. When we talk about the married put, and we talked about EWW buying 100 shares of stock and buying the January 2020 leap put, doesn't mean I'm going to stay in it for that long, but I'm buying that as the protection long term so I can manage it in different ways. We've got a limited risk structure with unlimited upside, and we're tying up a lot of capital. So Fernando's question is a common question. And it helps answer, or not answer, but it helps to comment on Sam's discussion as well about, you know, Sam said he doesn't like to tie up capital. Neither does Rajiv. Tie up a lot of capital for that amount of time. And that's fine. Different strokes for different folks. What else can I do that's not owning the stock? Well, I could buy a call. Okay, Sam's talking about that, you know, doing straddles or maybe even owning a longer term call and doing calendar spreads against it. I do that with part of my portfolio. But what's a way to get into a stock more cheaply without buying it? Well, selling a naked put. But then that causes a margin requirement to cover the buy. What if instead of buying 100 shares of EWW, this is not a recommendation, this is just the example I was using today. So instead of buying 100 shares of EWW at a price around $49.40, $49.50, what if instead I sold the right, let's go just out to November, to maybe buy shares of EWW at 50 for $1.65. So if the stock is below 50 and it's put to me, my cost basis is actually $48.35. But I need that protection. And let's just go out to March. Okay, if we did a March married put instead of the January 2020, what if I was planning on buying the March 52 or the March 53 put, but instead I sell that near-term 50 put and I already have my protection in the 53 put in place. In other words, Fernando's question, using a calendar put spread, this thing, every time I refresh the page, calendar put spread to get into a radioactive trade. This is the second question I asked Kurt when he started teaching me the radioactive techniques when I got introduced to it, and we were partnering up with Kurt back in 2007 because I was a calendar spread trader and figured, well, I know just as much as this guy who says he knows married puts are the greatest things in sliced bread. Why would I buy the stock? Why wouldn't I just sell the put to get into the stock at a lower cost basis? And if I am put the stock, I already have the put in place, so I've essentially done an income method already for 167. What's the problem? The problem is, up to this point, to get into the married put, I researched the stock that I had the expectation is going to move up 3 to 6% in the next 30 days and has the potential to maybe gain close to 10% over the next 10 to 12 months perhaps, maybe 8 to 10. That's the stocks I'm looking for radioactive trade, something with strong growth, solid movement, because it is a position that has infinite upside with a controlled risk that's not leveraged like a long haul. Well, if I'm expecting the stock to move up 3 to 6%, it's here. What happens? My put expires worthless, I don't keep the premium, and the put that I bought is losing money. Oh, sorry, folks, there we go. If I'm in a married put, at this point, it'd probably be more like this, the 53, I'm already at a profit. All right, we're sort of crossing paths. The calendar is going to be losing money beyond that. I'm going to be gaining more money. Okay? What happens if the stock stagnates? Okay, well, this put expires, and you sell to open a new one, hoping to get in the stock at 50, and you do generate a new premium against it. That is a benefit of this. But the key that I found is that if this starts to move down, yes, you get put the stock, and now you can start trading it, but eventually, if the stock's trading down here, you've got to move this put because now you're too far out of the money to do anything with the position. You can't sell a 53 call if you got put the stock when it was down at 49 or 48. You've got to move this down in order to do it. That's going to increase your risk on the position. Now, I'd do the same thing if I was in the married put to begin with, okay? And what if it keeps going down? Now you have to keep moving this put and moving this put and moving this put. That's kind of okay. You're still generating a premium, but you're not getting really the advantage here of this position. I don't do this, Fernando, and do you know why? Because I did this when I first started trading radioactively. I did them side by side. And as you've heard me say in other webinars, that 3 to 6% in the first 30 to 45 days or so, I'm right over about 67% of the time, which means that I'm losing money 2/3 of the time with this structure when I'd be making money in a married put. I was better off doing a straightforward married put based on the stocks that I've been selecting for 10 years that move up in price. This is not the structure that you want if you think the stock is going to move up in price. It's a different strategy for a different stock. Could you get into this stock more cheaply? Yes. Where's the range that you want the stock to be? If I enter this position for November, 45 days away, break even is 47.14. That's including the value of our long put. But in reality, with the 167 we took in, that would put my cost basis at 48.33. So I want the stock just to be between 48 and 51. What I'm saying when I open this position is that in the next 40 days, 45 days, best situation is the stock is between 48 and 51. Below that, I start getting into trouble. Above that, it starts not making sense for me, and I have to maneuver this position because remember, on the married put, I'm getting +1 delta on the stock. Here, all I'm gaining is the loss of time premium of that $1.67. If it gaps up, big market correction on Monday, let's say, or correction to the upside, and this stock recovers and goes back up to 52, 53, or 54, I'm losing so much money in my put, and I'm scrambling to try to sell a new put that has any premium to it to really reduce that risk, or try to buy the stock now at 53, 54. Would have been better buying it at 49, 58 at that point. It didn't work for me because I was selecting the right stocks. Stocks that moved up my desired amount. This is not the structure you want. If you find 70 to 75% of the time on the positions that you're choosing that in the first 30 to 45 days, the stock does not move more than ±2%, again, 70% of the time, and then after the stock stays within this ±2% range for the first 45 days, 70% of the time after that, it goes up another 5 or 6%. This is a structure that will work well for you. That's not what my experience has been with the stocks that I've been selecting using the search for the married put. 67, 68% of the time the stocks do move up 3 to 6% in the first 45 days. That's not the structure I want for that rate. Okay? That's why it doesn't work. Okay? And again, Rajiv says maybe we can try it with ETFs more than stocks. I generally don't trade the radioactive techniques with ETFs because they're too slow moving. Okay? Again, Rajiv, it's different strokes for different folks. I'm not saying calendar put spreads are a bad strategy. I'm saying that I would have lost money on calendar put spreads had I been doing them with all the stocks I've been doing married puts on for the past 10 years. Where I'm profitable now, I'd be in the negative because I was picking stocks that were designed for a bullish strategy like a married put or a long call, maybe even a diagonal call spread. My married puts sort of over time, percentage-wise, are on par, a little bit outperforming my calendar call spreads. But every now and then you take a big loss on that calendar call spread, which is why diagonal spreads and bull puts only represent about 15 to 20% of my account, and married puts represent 50 because I don't have the live leverage. Okay. All right. So that's just Fernando there on that comment. That's why I do not look at trying to use a diagonal spread. The 3 ways, by the way, that investors kind of look at this and say, well, why are you buying the stock at all? Why wouldn't you just do the calendar put spread? That's one of the trade comparisons I discuss in those webinars. Naturally, the other one is, why buy the stock? Why not just buy an in-the-money call and buy the put that you'd want? Well, now you're in a long-term in-the-money strangle where you need a much higher move to break even on the upside and a much higher move to break even on the downside. But you can break even on the downside, other than the married put, of course, which you'd be at a loss. 7 out of 10 times with the positions I selected, that 3 to 6% movement is not enough, meaning comparing this in the money long strangle idea to the straightforward married put, you know what ends up happening? In the first 30 to 45 days, this is still a loss at it's a loss of 8, 9, or 10% because you're not delta neutral, you're delta opposed. You don't start getting value with that long call until it moves up further. I'm at a 2, 3, maybe 4% gain on the married put with a 3, 4, 5, 6, 7% gain in the stock in the first 45 days. I'm at a loss here, and it's a leverage loss of maybe 8, 10, 12%. Even if it's only 20 or 30 cents, 8, 10, 12% of what I invested in the position because you need more movement. So I don't think trying to get in the married put as a calendar put is better based on my experience. I don't think using in-the-money long strangles in place of the married put is better. And someone says, why not just use the in-the-money long call? Well, there's a time and a place for that. I'm not going to do a married put on Amazon or Google. I might do a long call on Google, but only a couple contracts because of the cost. All right, if I'm still bullish on those long term. Or I'll do a different strategy because of the price. But again, the lie of leverage. You overtrade and you see a drop here. Remember, you can lose 100% of what you invest in the call if you're not watching it carefully like Sam does, if you're not hedging it with other positions as Sam and as Rajiv does. Very quickly, I see too many investors just buy a call thinking the stock's going to go up. Before they know it, they've lost 100% of what they invested. And too often, they said, okay, well, I've got $5,000 to trade. I don't want to buy the stock. Let me buy 20 contracts. And they couldn't afford to lose 90%, 80% of those 20 contracts they purchased, but they just did. So that's why you know why I trade the way I do and why I say that getting into a married put by way of a calendar put or using an in-the-money long strangle or just doing a long call, I don't think is as profitable long term. And I mean long call just as a basis plan. If you can't force yourself into an ideal size trade, if you cannot force yourself into a proper structure, and if you're over trading because of leverage, you will lose 80 to 90% on a long call before you can adjust it, before you can add a put to it to protect it. A lot of times if you're gambling on that situation. Okay, let's go to Rajiv's first question now. It was related to the Power Options tools, I think. He says, on Power Option, I'm looking for a company list with having quarterly results in 1 to 10 days. I'm not getting a complete list, just a few of the company lists. I tried with clearing a filter now, only select earnings date in between now and expiration date between 1 and 15. Okay. So what Rajiv is asking is he wants a comprehensive list of securities that have earnings coming up between the next 1 to 10 days. Okay, and I'm sorry, Rajiv, I just kind of looked at your second question. I think I might have answered that already. So what I would do here, it doesn't matter what strategy. I'm going to take just a single option strategy, Rajiv. I'm going to go long call. Now, one of the problems you might have been facing, and I think we talked about this, and I think you said it, you mentioned 15 days in there, but here's the thing. I'm going to clear filters, and I need to look for any stock. I'm not even going to use a list. I'm going to look for any stock that has earnings between now and 10 days from now, right? Somewhere in that time frame. Okay, now, I can't, here's a trick, here's a trade-off. I can't look for options that expire between 10 to 25 days, 15 to 25 days. Okay, I don't really care about the options right now. You're looking for a stock list. What you have to do is either select October or November. You have to select one of the next two standard expiration dates. Why? If I shorten a time frame for expiration dates between 0 to 15 days from now, for example, I might be cutting out things, of course, that don't have the weeklies. Okay, I might only be seeing stocks that have weekly options, not standard expiration. So I'm going to select just October. Now, I don't want every strike price from every option that might have an earnings date between now and 10 days from now. So I'm just going to put my strikes out of the money, number of strikes, 1 to 1. It can only show me one strike out of the money. So what am I telling the system? Show me anything that has expiration in October, which is all optionable stocks, ETFs, and indexes, which ETFs and indexes are already removed, Rajiv, because they don't offer earnings, that offer earnings between now and 10 days from now. And by the way, just show me one strike out of the money for each one, so I only get one result. I might get two. Oh, I'm sorry, I will only get one. That's what I want. I've got a list of about 400 stocks that have earnings between now and expiration, between now and 10 days from now. That seems like a lot. Did I do that right? I want earnings between now. Oh, I'm sorry. That's weeks. My apologies. Let's get that corrected. Let's say 2 weeks from now. Next 14 days. Very sorry about that. I thought that was days. It's weeks now. Okay, so I want something with earnings between now and 2 weeks from now. 198. Okay, so October is within 14 days to expiration. Between now and 2 weeks from now, most of these stocks are going to have it. I have 198 total results. That one-to-one strike for me is important. You don't need to use the one result per security if you're doing this, because you're telling it just to give you the one strike that's out of the money. Okay, so each one of these should only have one result per security. Let's just double check, but we should still be at 198 total results. Yeah, still at 198 in that case. So that's what I would do, Rajiv. If you're still not seeing what you want there, if you try to go to it after the webinar before I post the archive, send me an email this weekend. I'll try to check it and see what we can do. Okay. All right. So let me scroll back a little bit. Sam, as a reference to Mark, Sam says Apple might be a better idea in this case for EWW. Sure. I just grabbed EWW because it was in the $50 price range. That's what I was looking for. Sam also might consider Apple a way to get into the using the calendar put spread as well for a married put. Okay. Rajiv says, I think this is one in relation to Fernando. He said it tried the same strategy as calendar put, but it was very restrictive. Normally, the stock move unbounded, and yeah, you're either missing out on the upside profit because you're short the put, not gaining more than that, or you're just not getting it. The put's losing money. Oh yeah, Sam had an earnings on SFIX. That was one of the ones he had mentioned. I thought in your email. Oh, you sent it was the email you sent at about 4:10, 4:15. SFIX down another 8% today. A Stitch Fix, yeah, but this was his good straddle trade here. So it's from 45 down to 35. That break there from the earnings, and then it's continued down lower. It's stock's 40% down. Did not sell any calls or puts in this one. He's just riding it out. Good move. Good move. Just let it ride. You're not going to get anything back for the call at this point. It's only worth maybe 1 cent to 2 cent bid-ask spread. So yeah, just get that. Keep milking the puts here. Sam's going to clarify what I said. He says he likes the SPY 2 months out straddle. Okay, so there's two things here. Sam did the straddle we just showed on SFIX, which has the big drop. Ernie, remember we talked about this, his introduction to straddles video that he has here is discussing using earnings shorter term, 5-7 days out in time, on stocks that have earnings between now and expiration. Of course, he's doing a little series on that. This is the introduction to his new approach to straddles. Sam's approach is sort of Sam, if he knew I would have done this trade, he would have been looking at a really good profit right now. But what Sam probably does, so some of you may have known if you were with me on the webinars earlier this week, the newest position I opened for Fusion, for radioactive traders, was I bought Penn at 33, and I bought the April 35 put for 410, 420, somewhere in there. Let's call it 450. That was 420. It was 420. Sorry. Okay. So at the time, I'm not going to show you the profit and loss chart. At the time, this has been a fun trade for 4 days, let me tell you. So at the time, we got in on Tuesday at about $30 per share. MACD positive crossover for the past couple days. I'm sorry, 33, so it was right in here. And yeah, it was Tuesday. Right in here, early in the day, got in at about 33. I got a great price on it, I thought. So, okay, but got the 33, have the 35 put. Positive MACD cross. RSI was gaining, just went above the 20-day moving average and was getting up the upper Bollinger Band. These all things look good to me. The next day I looked like a genius and almost reached 35. And then it gave back and it's right back to where it was. And today, boom, it's down 10%. Okay, so that's what I'm in. What Sam might have done in this case, based on how he trades sometimes, and Penn, I don't know if something that would have come up on his radar, what he might have done is you would have had to go out to January. You might have gone November, Sam. But you might have gone out to January, and you might have bought, let's say, 30 call, 31 put. The prices would have been different. Oh, no, I'm sorry. You would have, at 33, it would have been much different. I'd do that again. Maybe bought the 32 call and the 32 put, or maybe the 33, 33. The prices would have been different. I know the 32 put, of course, was probably going to be around 185, and the 32 call would probably be about the same. Maybe a little bit higher. Oh, I'm sorry. Anyway, so a straddle or a strangle he might have done in this case. This is a straddle when they're the same strikes. Okay, but the movement upwards, when it moved up to about 33 or 34, Sam might have sold the call, or he might have just kept it, but he might have sold the call and bought an extra put. And then, of course, today he's in a different position. Right? He's moving in and out of the two different legs. That's a possibility. Of course, what I ended up doing on the position is today, when I saw it fall 5%, and I saw the MACD cross, and it was about a 5%. It was when the stock was at 31.10 or so. I bought the 30 put. So now I have a 35 put and a 30 put for November in case this continues a short-term downturn. So I've got a synthetic straddle in this right now, sort of what we call a different adjustment here. But I've got an April far out put, the stock, and a short-term put. And the most I can lose here in the worst-case scenario, if I hold it to November and the stock stays right at 30 without doing anything else, is going to be about 7%. That's the absolute worst-case scenario. If it falls below that, I'm going to start making a profit quickly. If it goes above that, I'm still making a profit because of the delta will go to zero very quickly on this 30 put, but I only paid $1.40, $1.45 for it. So it's a decent position. But I saw the crossover, and I said to myself, I missed it on Pulte Group, PHM, another married put I'm in that just kept going down. And so I didn't want to take a chance here. So things look bad today. They might come back up on Monday. But again, it was only $1.45. I'm profitable 60 cents on it right now on that put that I bought today. So that's good there, okay? All right. Rajiv, another comment that came in related to sort of this question, related to sort of the married puts. He says, for the married put, is it advisable to create a short put position 30 days, still own the stock when the stock falls suddenly with the market and recovery in sight because we already had long put with the stock? No. Yeah, Sam said he would have sold the calls and let the puts run. Yeah, that's what you probably would have done. If Penn moves higher, then sell the puts. Oh yeah, if Penn goes higher, let me just show you very quickly. I've got a game plan, and I told our Fusion subscribers this today. So here's Penn. Over the course of 4 days, now 3 days, I've lost $2.79 on the stock. It did recover back to 30, but I did this when it was at 31. So I've got 30. Oh, it's only 30-cent gain now at the end of the day on the second put I bought today, and about a $2 gain. By the way, that was the target here. When I did the trade and bought this 30-strike put for November at 145, why did I choose 145? Because I had a 160 gain on the first put I bought. Okay. Yeah, Sam says, just as an idea, to give you an idea of the straddles we're talking about, for Sam, he was in Nike for 3 weeks and he was in Stitch for 2. Okay. But just go into this position and the management, as we're talking about, with the married puts, with other positions as well, following the trend line, following those, that 7.3% is the worst case scenario at November expiration, as I mentioned. So what happens if the stock starts to recover and we start seeing it go back to 31 or so? What am I going to do? Well, I'm going to sell to close this put for a small loss, maybe 30, 40, 50 cents. I'm going to sell to close this put for a $1.50, $1.40 gain, and I might move it in time from April to January at a lower strike. So my cost basis, we're going to cut that down by about probably maybe $1.20, $1.30, maybe $1.40. I'm going to cut the total cost basis down, but I'm going to pay much less for this closer in time put at a lower strike. So if it continues to move up, I've got a much lower cost basis into the position. Actually, if I sold to close this at 580 and then buy another one for probably $1.10, $1.20 for January, my cost basis will probably just go up to about 34. I'll have a 32 put, but the stock would be back at 31. So if it continues to move up, I'm going to be back to break even faster, and that's a perfect time to do income method number 5 as well, ratio call spread. So I've got a game plan in mind if this reverses. If it continues down, same thing. I'm going to sell to close the 35, sell to close the 30, take in $7 to $8, really reduce the cost basis, and buy one lower strike put for a cheaper price in that case, or buy two and continue that little straddle effect. So I've got a game plan in mind based on what hand shows me next. And of course, this could get me like Goose gets me all the time. I get goosed by Goose. So, you know, GOOS is all over the map. It was up $1.45 this morning when everything was down, and then it was down by about 30 or 40 cents when everything was down $2 or $3, then it came up to be up 91. And one of our Fusion subscribers, real quick, let me just show you the chart. So I'm in a Married Put in this position. It's coming up to expiration. When the stock was at 56 a week ago, and you heard me say this on the webinar, my greatest trade last week was not selling the 57.5 call when the stock was here. Hindsight's 20/20, right? But I look like a genius because I didn't sell it. I should have sold the 64, the 65 call here. But what happens if on Monday the market recovers and this goes back to 63, 64, which you see it does in a 4 or 5 day period, has a tendency to just do these swings. If Monday's still a down day, I've got an adjustment I can make. If Monday's an up day, I've got an adjustment I can make. So I'm okay with this one right now. What I don't want to do is say, oh, I've got to react with this move at the beginning of the day just to watch it come back to right where it was and then go up 91 cents higher. Okay, this one has trapped me before. So I just kind of let it run a little bit, but I am getting close to expiration, so I've got to control that. Okay. But that's, okay, going back to square one, let's go to pen again because it's my most recent one, Rajiv. I'm sorry, I trailed off there. I'm sorry. I saw the other comments come in, Rajiv. I apologize. That wasn't handled well. Why would I not sell another put as the stock's moving down, even if I think it's going to recover when I open a Married Put position? Well, the reason why is because I'm neutral to bullish on this stock, and right now it's showing me the opposite trend. I wanted to buy a put in this case. Oh, whoa, no. Okay, let's get the right prices. All right, so it's showing me the wrong hand. Now, if I think it's bottomed, do I want to sell a put? Not really. I don't personally. I think that's too much of a gamble. Let's say even go 14 days out, and I think it's bottomed, so let's do the 29 put here. We're going to sell that for about, was it 50 cents or so, 55 cents. Okay, so it still looks good, but what is this? Because if I'm wrong, if it hasn't bottomed, like GE, like everything else, this one put I own can only cover the stock or that naked put. It cannot cover both. If I'm right and it moves back up and this expires, yes, I've reduced the cost basis of the position by 55 cents. It was like doing an income method where I didn't cap the gain and get trapped because I sold a call. But I'm going to have to put up a little bit more margin to get into this position. My broker is either going to see this as a calendar put, but they likely won't because I legged into it. So I've got the $3,700 invested in the Married Put. I sell this 29 put, they might have me put up another 2,900. Okay, so now you have to take it in consideration that any returns you consider you're getting in that first 30 days, you shouldn't be dividing it by the capital you have in the stock. You should base it on the entire amount you put up into the position, which is going to be close to about 6,700. Okay, 3,029 for that, and 37 there. So okay, it's 6,690 or so. I don't like it because if I'm wrong. I couldn't do the November because one of the reasons I opened this trade is that earnings are supposed to be coming out on or around October 25th. I don't want a naked put in place that's not protected by a put because I also own the stock heading into earnings on October 25th. I might buy an extra put for this one, Rajiv, in that case. Yeah, so when the stock falls suddenly and you think it's going to go back, recovery is in sight, well, again, what's your poison? You can do this. I'm not stopping you. This isn't in the blueprint. This isn't one of the income methods because it doesn't match the goal of an income method. General goal of an income method is to reduce the risk and increase the potential profits while either generating income or lowering risk. This increases the risk drastically. And you can say, oh, well, if it doesn't drop below 29, we have to look at the entire picture. It increases the risk drastically. At the same time, you may have to put up more money to cover the margin if they don't read this as a calendar put spread with a long stock. You did generate some premium, so we're checked there. It does leave the upside open, but the other two are too much of a mitigating factor for me. Okay, so you said you did this with Intel. You hold the January 50 put, and you sold the 47 put before earnings on October 18th. Okay. If it doesn't drop below 47, what's the other risk? It drops below 47. What if you get put the stock early? Now you've got X amount of shares, let's just say 100 shares uncovered at a lower cost basis, and you've got another 100 shares covered by one put. You've either got to buy another put or sort of average out this position and adjust as possible. Okay, that could get you into a position. Okay. All right, so that was, yeah, Fernando's questions there. We've got that. Let's see here, Sam's question. So Rajiv, yeah, I mean, you sold the 47 on Intel. Got that. I just, let's see how it goes. You know, I just say long term, usually when I'm wrong, oh geez, and the stock breaks below those 2 or 3 technicals I look at and keeps going down, I'd be in a worse position selling the put. I would have been better off buying the extra put. Okay, but that's just been my experience. Yeah, so let's see here. Oh, good, Sam. You did do a volatility. Sam was also in UVXY, got in shares at 35, sold out as 41. I had gains there on my positions for the VIX calls too as the hedge for the broader portfolio as well. Okay. Let's see here. Oh, yes. So the 2-month straddle, when you showed the example, the 2-month sort of straddle Sam was talking about versus the married put, all right, that he might be going out to November now, buying that call on the put. And he tries to sell, he says, I like the SPY 2-month straddle. I am in at 294, and I'm selling 3 times a week against calls. Stop selling puts for the week because SPY is down. Okay, yeah, so he's still got to follow the trend. And with the snapbacks that you might get, not on SPY so much, but on the stocks like Goose or Stitch Fix, when they try to have that push back up, you might get trapped being short the calls. You've got to roll those and then go into another position, okay? Okay, and Rajiv was commenting on the other positions there that it might be the short-term call buying might be a better approach, but again, only if you're disciplined, you watch it enough as well. I can't answer this question, Rajiv. You know that. You say, is Snap worth looking into or avoid? I don't know. I haven't been following it. I don't know it. Strategies I'd be trading right now would be a bull put credit. Well, not right now, but on Monday I'm going to look again at my calendar spreads. I think next Monday is opening calendar spreads. So I'm going to be looking at calendar call or calendar put based on what the market does on Monday. I wouldn't open this for a calendar call or calendar put right now, just eyeballing it. I wouldn't open it as a bull put credit spread. I would not open it as a married put. I doubt I'd open it as an iron condor because I don't think there'd be enough premium there. I know it's volatile, but I don't think there's enough premiums to give me the safety I want. I'd want to go to the 4 and the 2 and maybe the 12 and the 14 for a 4-legged spread. I just don't think the premiums are there to do it, to make that worthwhile. That's the only safety I'd consider with something that's down 48.3% in the last 30 days or so, from 11 to 850 or 750, 777 there. I just can't comment on it. Yeah. Sam just says, if it helps you any, Rajiv, Sam says he got out of his snap puts today. He still had 2 weeks to go on it, but he's not sure what's going to happen next, so he just wanted to take the profits and get out, not worry about anything pulling back. He'd hit his target point and he's gone. Don't continue the trade. So that's all the insight I can give you. I can't give you any direct advice on a stock. For the strategies I trade, just looking at that chart wouldn't match what I do, and the structures of the trades that I've shown, not Marc's structure. I don't mean that. I don't mean the opposite collar, but the ones you know that I do in my personal account, the standard collars, married puts, diagonal calendar call spreads, and sometimes the straddles on earnings. I wouldn't touch anything on Snap right now in the strategies I'm opening in my portfolio. That's all I can answer that. Doesn't match what I'm looking for. Would I consider... if I did anything, and I wouldn't, I'm just going to say that. No, it wouldn't come. I'm not even going to say it. It wouldn't even come up. Okay, so you're looking at a position that's down. You don't know if it's going to move up or move down. If you could find a relatively, perhaps low-risk standard collar 1 to 2 weeks out in time where you could make 2.5% if you're right, and it goes up and you're assigned on the short call, and you only lose about 2.5 to 3% if you're wrong and it falls on the downside, is that worth a chance to you? Again, I know for a fact that looking at that stock chart, it would not come up in my collar search. But if I'm very unsure about something, I don't know the next direction, I don't know where it's going, I'm not trading it. But I'm also not trying to hit a home run by saying, hey, if I get this right, I could make X or Y. No, you know me better than that, Rajiv. I stay with my strategies in the trading plan. And if a stock, the premium, the chart, doesn't match what I look for a diagonal call spread, a married put position, a standard long collar, a bull put credit spread, or if I switch to bear call credit spreads, then I'm not entering it. I think I said this, I don't know which webinar I said it in this week. I can't remember if it was Tuesday or Wednesdays or Thursdays. I apologize for that. I'm pretty sure it was Thursdays. But again, I'm sorry, it doesn't matter. The idea there is I tend not to follow the hot stock. I don't follow a stock that's in the news. If I hear something in the news, I run the married put search and I see it, I'll probably jump into that trade. Okay, if it matched my other criteria and I just heard about it in the news, I'll do it. I haven't touched any of the marijuana stocks. Honestly, missed the boat completely. I don't care about that because none of them came up in any of my searches for the strategies that have been working for me. I'm more strategy intensive. I'm not objecting to doing other strategies. I'm not objecting to what you guys are doing. I can't object when we hear Sam talk about his profits he had in Tilray and CJC. It was phenomenal. It was great timing. It was really great trades. Yeah, it told us 2 weeks ago, paid for his trip to Australia. I don't mean to trail off again, but all I'm saying is that I tend to trade in that direction. I am always willing to learn from you guys. I'm always willing to learn new strategies. I look at the stocks Sam mentions. I look at the stocks Rajiv mentions. I look at the stock that Marc mentions. I look at the stock that Paul mentions when he talks about his calendars. And if I see in my searches for any of the strategies I'm opening positions based on my market sentiment, I see any of the stocks you guys had mentioned in the past 3 to 4 months come up in one of my searches, I'm probably going to take that trade after I look at the chart and see what it's been doing since we talked about it. Okay, so you got out of that. Sam says he got out of the Tilray today, lost about $10. Yeah. All right. So Rajiv, you have something here. Fall too fast, mean reversion. How can PowerUp help to find the stocks which far from mean, 19 days average, and ready to revert mean both direction? I can't answer that directly, Rajiv. I know what you're kind of asking. You're saying you're looking for stocks that fall too fast, mean reversion. How can PowerOpt help to find the stocks which fall from mean, 19 days to average mean, and ready to revert mean in both directions? There is a way to do it, but it's difficult, meaning that it's not I don't have a straightforward answer for you. I'm going to have to get back to you on that, write up a blog maybe, or I'll send you an email, or I'll talk about it in one of the next webinars. It's going to be a combination of one of three things: bandwidth and Bollinger Band range with MACD, or bandwidth Bollinger Band range with RSI. And I'm going to take a look at some examples of that to see what settings, or I could be wrong and there could be no combination of those three. That's my first guess, is that there's a way to manipulate those three to find what you're looking for. Of course, on an offshoot, I do want to mention, of course, that this was neutral now, but there we go, view overall sentiment history. I did sell a lot of calls on some of my positions, and I adjusted my diagonal spreads based on this that came up on 10.2 and 10.3. So the sell warning triggered on 10.2 and 10.3 with 5 and 8. So I planned and sold short calls and bought extra puts, as I mentioned, and of course that worked out really well for this when we saw the sell warning there for the sentiment tool. So that worked out pretty well. I'm not saying that that's a gauge to help you pick stocks that revert to the mean, but once again, that sell warning came up early, and I was allowed to get some profits off of the short calls that I sold on Wednesday when we saw the sell warning, as well as profit on the extra couple of puts I bought on the Married Put position and a couple other positions as well. So, all right. Well, ladies and gentlemen, I don't see any other questions or comments coming in, and we are just about at 6 o'clock Eastern Time. As I mentioned, sometimes I apologize. I do tend to trail off a bit. I apologize for that. But we did have, I was covering all the comments that were brought in by Marc, Sam, Rajiv, Fernando, and more. I do want to, of course, mention to everyone that today's material are my thoughts based on your questions, designed for educational purposes, increasing investing performance, and options knowledge. They should not be in any way, shape, or form be taken as direct recommendations or suggestions on which strategies and which stocks to trade or which adjustments to make. Any stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk and, of course, may not be suitable for all investors. Sam H, different Sam entirely. I'm just going to do this real quick. Let me jump screens again. I know this might get a little fast here, but let me just jump screens. He says, is there more information on your Fusion? Yes, Fusion subscription is available at RadioActiveTrading.com. The Fusion subscription is $69 per month, but if you pick up the blueprint, the full work that describes radioactive trading techniques, you can get your first month of Fusion for $10. The Fusion subscription includes a series of lessons, Sam, that you can follow to help master the material in the blueprint. There is the RPM report, which shows you the Married Put positions based on the radioactive trading structure, what's taught in the blueprint. The criteria there, these are the positions that Ernie and I would get into if we were opening a Married Put position today, based on what's worked for us over the past 10 years and what worked for Kurt for almost 8 to 10 years prior to the 10 years, almost 20 years. A stock insurance tool, so you can put in your stock symbol to see which put would lock in the most gain, members-only webinars and white papers, and then the open trades and trade tracker. This is where you can see our positions. So you've got Ernie's positions that he enters for Fusion subscribers, all based on the radioactive trading techniques, all stock plus put combinations, and our application of the 12 different income methods in that Married Put structure. And then there's mine, of course, as well. And you see the Penn Gaming one, the adjustment made today, that extra put that was purchased as well. And then, of course, Greg's ones are down here, too. So you get, at any time, we usually have, each of us usually have about 6, 7, or 8 Married Puts open. Okay, 6 to 8 Married Puts open, I should say. And adjustments, you know, come as necessary. We don't have any planned schedule to make an adjustment, sell a call, or do anything in that regard, Sam. It's all based on following the rules in the blueprint and the correct application of the different income methods as well. So you can see more about that at RadioActiveTrading.com. Again, if you own the blueprint, if you purchase the blueprint, you're thinking about getting the blueprint. If you pick up the blueprint, you can get your first month of Fusion for only $10, and it's usually $69 per month after that. Now, if you'd like some of the tools we saw today with the profit and loss chart, we looked at some searches a little bit. But if you want to take a 14-day free trial with no credit card, remember, just go to PowerOp.com at any time, put in your name and email address, and just click Start My Trial Now. We'll send you a password. You'll have full access to Power Options for 14 days. Subscription levels after that start at $40 per month for the end-of-day service. Upgrade to that, the most popular, one of the most, probably the most popular level of service is the 20-minute delayed service at $60 per month. The upgrade from that is the historical service. Gives you full access to the backtesting search tool, historical option chain, historical search by symbol, and our historical data goes back to April of 2006. It's about 12 years of historical data for options and strategies as well. We do, of course, offer real-time service and the full kit and caboodle, historical plus real-time plus the API, the programmer's interface, is $160 per month. Now, if you want to check out some other free education, remember, go to the blog anytime, blog.powerup.com. As mentioned, check out our webinars page. You can see the archived webinars at any time. It's a public page. Just go to powerup.com/webinars.asp. Coming up, Tuesday at 12 p.m. Eastern Time, we're going to have a live webinar on discussing the role of the income methods. So I'm going to discuss 2 or 3 of the income methods, not in depth, but just show you some examples of what they are, when they might be used and how to use them in relating to the radioactive trading techniques. You can register for that webinar at radioactivetrading.com. Wednesday at 12 noon here, we're going to discuss using the Power Options tools for researching and analyzing a stock or an option position. And you can register for that at powerop.com. And then, of course, Friday at 4:30 p.m., well, you know where I'll be, and I know where some of you will be as well. And, of course, you can always check us out on YouTube. Just go to YouTube and look up Power Options. Most of our videos are archived there as well. And if you think of anything else you want to discuss from today's discussion or something that jogs your memory, send me an email at any time to support@powerop.com. You can also reach me at support@radioactivetrading.com. You can call us during market hours at 302-992-7971. Remember, if you're a trial member or a subscriber, feel free to schedule a coaching session at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Sam, thank you as well. Rajiv, thank you. Marc, thank you for your questions. Fernando, it's good to hear from you again. He's chiming in all the way, of course, from Italy. I have about maybe one session every 3 weeks with Fernando over online, GoToMeeting, GoToWebinar. So it's good to see Fernando here as well. I do want to thank you all for joining me today. Thank you all for your questions. Have a fantastic weekend. We'll see you soon. Good night.